Hey class, in the following video, I kind of messed up, and to your benefit, you're not going to see me in the video. You'll hear my voice, but you won't see me. I've been experimenting with different ways to record because my computer was running a long time doing videos, and sometimes it crashes. And so, anyway, I tried something and I lost my video. So, but if you like not having to see me during the lecture, give this video a thumbs up. All right, see ya. So let's jump to chapter 11 now. Chapter 11 is still on fixed income, but now it's specifically looking at strategies on how to build portfolios of fixed income. And one of the big risks we have in fixed income is changes in interest rates, right? So, it's kind of funny because, when we think about investing, like most people are like, oh, how can I get the highest return, right? But in finance, really, we spend a significant part of our research and time, instead of like just worrying about returns, we worry about risk. Because if we can get rid of the downside risk, then what we have left are good returns, right? And so for bonds, right, we looked at default risk. We did that in chapter 10. So what are the risks if we invest in a bond? If the company, the issuer, stops making their payments, default risk, that's a big risk, right? Another risk is when interest rates change. I mean, those are probably, if you think about it, the two biggest risks really, right, with bonds. And so that's what this chapter kind of looks at really, is changes in interest rates primarily. And so, just as a note, when we're looking at stocks, right, we want to think about, okay, what are the risks of owning stocks? And some of the risks of owning stock is if you all of a sudden get bad news about a stock. So how do we get rid of the risk of getting bad news about a stock? Well, you build a big portfolio of lots of stocks, and that gets rid of the risk. And what are the other risks of investing in stocks? It's market risk, right? And market risk is when the entire stock market crashes, when we have a recession or something like that, right? And that's kind of hard to get rid of. But there is a way to minimize market risk, and that's diversifying across asset classes. So yeah, we like stocks because historically they've given us the greatest returns over time. But stocks have their own risks, right? And there are some other asset classes that help reduce some of that risk if we diversify a little bit out of stocks. Fixed income is an example, and then also we have commodities like gold, which is going crazy right now, or has been. And so let's talk more about fixed income, the risks, and the risk now specifically is interest rate risk. And on the slide here on the left-hand side, what this shows is interest rates or yield to maturity from about 1970, it looks like, to about 2008, right? And it has three lines, and the three lines represent, let's see, the black line is the 10-year treasury yield to maturity. So like 10-year treasury, that's notes, right? And then the red line is the 90-day T-bills, and the dashed line just represents the difference. So it's basically showing you the difference between long-term and short-term interest rates. The key thing I wanted to show you on this slide is that interest rates definitely change over time, right? And the other thing that we covered was this slide right here, and this slide shows bond prices to the yield to maturity in a bond, right? And the yield to maturity on a bond is going to be affected by other competitive interest rates in the fixed income markets, right? So when the Federal Reserve starts doing something to interest rates, boom, it starts to affect all the other fixed income securities. And so this curve shows how the price of a bond goes up and down when interest rates change. This is a big risk. Bond prices are heavily affected by interest rates. So we need to figure out how to measure this risk. Because if we're going to control the risk, we have to first figure out how to measure the risk. And then once we measure the risk, we can see what we can do to reduce it, right? This slide shows a couple things. On the left, on the vertical scale, it shows the percentage change in the bond price. And in the horizontal scale, it shows the change in the yield to maturity. And then these lines are basically 4 different bonds, and each bond just changes one characteristic of a bond. So what this is trying to show you is how when we change the coupon rate of a bond up or down, the time to maturity of a bond up or down, or the yield to maturity on a bond, like the initial when it's first sold, how that is affected by interest rate changes. So how the different bond characteristics lead to different bond price changes when interest rates change. So we already know that interest rate changes cause bond price changes, right? But it gets a little more specific than that. Specific bonds behave differently to interest rate changes. So I'll give you an example. Look at the dark red line here, A. That shows you how the bond price has changed with different interest rate changes. And you see how it hasn't changed that much. When you go left to right with the yield change, the line doesn't go up and down that much, right? The up and down is the price. But look at B compared to A. B goes up quite a bit more than A. And if we look over here on this table, you can see the main difference between B and A is the maturity. A is a 5-year bond and B is a 30-year bond. So the longer the maturity of the bond, the more sensitive the bond's price is to interest rate changes. So another way to say that is the longer the term the bond is, the longer the bond is, the more risk there is, the more interest rate risk there is. Okay? And then C, you see compared to B, it just changes the coupon rate. So it's the exact same as B and C are the same, except C has a lower coupon rate. You think about it, when a coupon rate is lower, you're going to get more of your money. You're going to have to get more of your money at the end, right? As a percentage, right? If you have high coupon payments, you're getting a little bit more along the way before you get to $1,000. If you have low coupon payments, you get less along the way. And so that par value on the 3% is percentage-wise a bigger part of the value of the bond. And then D, the only difference between C and D is the initial yield to maturity, 10 to 6%. I'm going to focus more on the time to maturity and the coupon payments on this interest rate risk because it's just a lot easier to understand those two. All right, let's look at an example of how it changes the price. So here we've got 3 bonds, okay? We've got a 1-year, a 10-year, and a 20-year, okay? So what we're going to do is we're going to see how when interest rates change, in this case, we're going to say interest rates are going to change from 8 to 9%, okay? What happens to the price of a bond for a 1-year bond, a 10-year bond, and a 20-year bond? We already saw in the last slide, 20-year bonds are going to be a lot more sensitive. They change price a lot more, right? And the other thing is when the interest rates go up, right, we know that the bond price goes down because they go in opposite directions, right? When interest rates go up, it means the brand new bonds being issued at higher interest rates look a lot more attractive compared to the old bonds that were issued at lower interest rates. Therefore, to be competitive with the new bonds, the old bonds, the price in the market comes down. Basically, until the yield to maturities, the total return you get by investing in either one is roughly the same. That's from Finance 300, right? But check this out. The 1 year bond, it dropped in price. Interest rates went up, right? And then the bond price went down about 0.94%. Behind the scenes, I'm not showing you, but there's math behind this, right? Calculating the bond price difference when the yield to maturity of the bond changes, right? A 10-year bond, look at that, went up 6.5%, and a 20-year bond went up 9.2%. If you look at bond returns, long-term bond returns from about 2024, you will see long-term bond ETFs, which you would think are safe, had horrible stock returns, negative, I should say bond returns. But the ETFs were horrible because from about 2024, right? Remember, the Fed was raising interest rates, right? And interest rates were going up across the board, short-term and long-term, right? Mortgage rates went up, remember? Because during COVID, mortgage rates were like around 3%, something like that. And as of 2025 here, we're sitting at interest rates of around 7 for mortgages. So interest rates went from like 3 to 7. And what happens is, and that's with interest rates going up, right? If the interest rate goes up, we know the bond prices go down. That's a little different situation than this slide. And just go take a look at some of those bond prices. They were pretty bad. It makes you rethink the whole idea about bonds being safe. Not all bonds are super safe. The super safest bonds we have are short-term treasuries. Why are they super safe? Default. As long as you assume the U.S. government won't default, which granted is a little difficult right now, they're safe, right? If the U.S. government doesn't default, treasuries are safe. 2, they're very short term, right? So if interest rates change, it's not a big deal because the security's only going to last less than a year, and then you can roll your money over into the higher interest rates, right? So short-term government debt is the safest thing we have. When you go really, really long-term, we'll get into this later, but it's safe if you only need the money for way out in the future tied to that bond. But like if you invest in long-term bonds and then sell them in a year, but interest rates went up, you're messed up, right? Because the bond prices went way down. I'm just gonna go over this slide fairly quickly because I realize it's a little scary looking. But let me just explain what's going on behind the scenes here. We want to be able to measure how bond prices change when interest rates change. And if you ever had calculus, right? A big thing in calculus is calculating derivative of an equation, right? And the derivative of an equation allows you to calculate how much something changes with respect to a change in something else, okay? And what we want to know is how much a bond price changes with respect to interest rates, okay? And for us, this right here is our bond price formula, right? And we want to know how much the bond price changes with respect to interest rates. And interest rates directly affect the bond's yield to maturity right here, right? So how much does P change with respect to Y? And okay, so You do a lot of little math here, blah, blah, blah. And what you end up with, and a little algebra, and you solve for the change in the price of a bond. How much does a bond price change? That's delta, the change, up or down, divided by the initial price of the bond, P. Why do we solve for delta P over P? Because that equals the return, right? So we're solving for the return on a bond when the yield to maturity of a bond changes. Okay, that's basically what we're doing. And this equation simplifies down to using the current interest rate and the change and something called D. The D stands for Macaulay duration. You don't need to know that in detail. What we're going to do, though, is we're going to use kind of the end formulas, if you will. So first off, this is our basic equation we're going to use to predict the change in a bond price when the yield to maturity changes, okay? So this is delta P over P. It's the percentage change in the bond price. And we need to know this letter D, that's the Macaulay duration. Then you have a negative sign, and it's 1 plus the current yield to maturity of the bond. Y is the yield to maturity. And delta Y is the presumed change in the yield, right? Because we're asking, we don't know what it is. We're just saying, can we calculate the change in the bond price for a given change in the yield? So we have to input that given change. And so this is what that equals. It's whatever we think the yield to maturity will change to minus the current yield to maturity, okay? So if it's going to go from 8% to 9%, the delta Y or change is 1%, okay? Now, this thing gets a little nasty. This is that Macaulay duration, okay? And the way to think about that is and this is kind of funny because the way I can't imagine how someone initially came up with this, but let me I'm just going to go back to the previous slide for a second here. Bear with me for a second. Because I think Macaulay, you know, kind of did this equation here, and then they got this third box here, and they kind of I have a feeling they just kind of like went up into the cave somewhere and started staring at this formula, and eventually they just got a eureka moment, right? And they're like, you know what? This part right here, sorry, in the brackets, this part right here, it looks like the weighted average time in years to each bond payment. So the bond payments come in 6 months, half a year, year and a half, 2 years, 2.5, 3 years. And so this, I know it sounds kind of crazy. You're probably thinking maybe they were doing something else up in those caves, but let me go back to the other slide. But that's kind of, that was like some of the original thought process. This right here represents the present value of the total bond cash flows, right? If we took the present value of all the bond cash flows, right, that's how we get the price basically, right? This right here is the present value of just one cash flow. Just one of the cash flows, okay? And so, and then this right here is the amount of time to that cash flow. Right? It could be half a year. It could be 1 year. And the point here is that you got this thing called a summation sign. And it's summing up this present value of each cash flow divided by the price times the time to that cash flow. And so what the way to think about this is a weighting factor, right? This is a piece of the price of the bond, and this is the total price of the bond, and this is the time to that cash flow. So duration is basically the weighted average of the time to each cash flow. The weight is based on how big the individual cash flow is, right? So the coupon payments are relatively small compared to the final payment of par value. The smaller the coupon payments, the smaller the percentage of the total bond price those coupons make up. Okay? If that's kind of like, don't worry about it too much. The main thing is, we kind of get a slight feel for it, so you understand that duration is the weighted average time to each cash flow, and we can use the equations. But that's kind of where this comes from. The textbook has this example, and so I'm going to show it here. First off, let's look at B here. So what this is basically a methodical, step-by-step way of calculating the duration D of a bond. And the textbook kind of puts it into a spreadsheet and kind of uses the spreadsheet format to make this calculation. If it works for you, wonderful. If not, the main thing is to kind of understand the concept. And I may maybe I'll do it just like the formula way without showing it on a spreadsheet, and maybe that'll be easier. Let's first look at a zero coupon bond, right? And in this case, the zero coupon bond has no cash flows from period 1, 2, 3, and the final cash flow is the first cash flow, is repayment of par value. That's the definition of a zero coupon bond, right? And so the idea here, if you follow that formula for duration, right? Remember we said it's the cash flow at time t, right? There's a summation sign, divided by 1 plus the yield to maturity to t. And that's like taking the present value, right? Divide that by the price of the bond, right? That I said is the weighting factor. And then you multiply that by the time to that cash flow. Okay? And you sum all these up, and that's duration. So first off, here are each of the cash flows. And that goes right here in the equation. This right here is the time to each cash flow. That's going to go here, but it's also going to be used when we calculate the present value. So the first part here is we calculate the present value of the cash flow. Let me change the color on this. So this right here is this part of the equation right here. Okay? And, since this first cash flow is 0, and this one's 0, these are all 0, right? Because the cash flow here is 0. But this term right here, $1,000, and we divide it by 1 plus the yield to the time of 2 years, and we get 822. Okay? So that is all these terms. And 822, if we sum up all these present values, 822 is the price of the bond. Actually, let me change the color again here. So 822 is the price of the bond. That's this right here. All right. And now what we do is we calculate this. I'll put this in pink. That's the PV divided by the price of the bond. So this divided by this right here, that's what we're doing. Each of these terms, 0, 0, 0, 822, we're going to divide by the green circle. So we get 0, 0, 0, and 1. And so these are the weighting factors, okay, which is this pink value for each cash flow. And then we take that and we multiply it by the time to each cash flow. Here's our time to the cash flow, and that was this right here, right? So we multiply this line by this line, and that's like multiplying this by this. Okay, and we end up getting this. These are all 0, and this was 2 years to the final cash flow times 1, the weighting factor, equals 2. You sum them all up, and you get a duration equal to 2 years. So when we calculate duration, we get a measure in time, which is years. And the interesting thing here, this is a general rule, on a 0 coupon bond where we only have one payment, it's at the very end, at maturity. And our question is, what is duration? Duration is the weighted average time to the payments. 0 coupon bond, we only have one payment at the very end, at maturity. So the time to that payment is 2 years, it's maturity. So for a 0 coupon bond, duration equals time to maturity, 2 years in this case. Let's see. So this is an 8% coupon bond. We have the same deal. It's a 2-year bond, right? We've got 4 periods, and this is the time right here to each bond, right? I'll put that in yellow, right? And then we have all our cash flows right here. So the first thing we do is we take the present value of each cash flow, right? And that's right there, divided by the discount rate. That's the present value of all these cash flows. And the next thing we do is we sum those up, and that's the price. And then we take each of these cash flows and we divide it by the price, and that's kind of our weighting factor, like a weighted average, you know? And then we take that weight and we multiply it by the time to each cash flow, and we get this column, and we sum them all up. And for a 2-year coupon bond, it's the duration is equal to 1.8852 years. I know that's a lot of work for not a big difference from 2 years, but you know, bonds can get all kinds of crazy, right? And if you're dealing with a huge bond portfolio, you know, decimal points matter. And so it may not seem like a big difference, but in the world of billion-dollar portfolios, it is a big difference. All right, and so you can see here, the duration is a little lower because we've got some bond payments sooner than 2 years. Now they're small payments, so they didn't move the average time that much below 2, but they did move it a little because you got these small bond payments, right?